This isn't all that complicated. Climate risk makes things uninsurable. No insurance makes things unmortgageable. No mortgages crashes the property markets. Crashed property markets trash the economy. It all begins with climate risk, and a major party pretending that climate risk isn't real imperils our federal budget and millions of Americans all across the country.
The music stops when weather disaster strikes.
I am so damn tired of being lied to. I don't think I can deny it anymore. You can stick to your story if you think it flies, but I'm not gonna buy it anymore.
Hello, my friend, and thank you for listening to the 294th episode of this listener-supported Congressional Dish podcast. I am your host, Jennifer Briney. And today's episode is not about Boeing. I know that I've been talking about this Boeing episode for a while now, and I promised that that would be the next episode, but shit got in the way. Specifically, me being on a Boeing airplane with a 10-year-old, because one of the reasons why this episode has taken me so long is that I went to California and spent some time with my family and brought a good chunk of my family back with me to Austin. And so my plan was to work on the script while on the plane, as I usually do. But as I sat down in my seat next to my 10-year-old niece, who was on her first ever flight, it occurred to me that maybe seeing Auntie Jen working on a script talking about a bunch of plane crashes, that might not be the most comforting thing for a little girl to read her first time in the sky. So I didn't work on the script on that flight. And while that flight was in the air, it turns out that there was another hearing about Boeing. And then a couple days after that, there was another hearing with the Boeing CEO. And so that episode is just, it's not done. It's just not done, but it'll be done soon, I promise. But while I was sitting on that flight, I didn't want to just burn that time. And so what I did instead is I watched a hearing that I just had saved on my computer, one that I was actually not expecting to be all that interesting because it was about homeowners insurance. But it turned out to be far more interesting than I thought it ever could be on first glance. And that's even for me because, you know, I'm someone that doesn't own a home and I never intend to, as I can't imagine wanting to live in one place for 30 years or 3 years for that matter. I have a nomad soul for sure. But it turns out that, you know, I'm not normal. And many Americans really do dream of living in a home for decades and owning it so that they can, this is where I don't know, decorate it as you choose and do your own maintenance. Like I said, I don't get it. I don't want to own a home ever. And to be honest, I also don't get how so many people have tricked themselves into believing that they actually own their home, when the reality is that the home is not really theirs until they pay the mortgage loan back that they often have to borrow from the banks to buy said home. Because if a bank can take your home away, it's not really yours. But that is the reality for most of the so-called homeowners in the United States. And because the banks actually control the destiny of that home while mortgage loans are still outstanding, the banks damn near always require the person they are lending money to have homeowners insurance in case the property that really belongs to the banks is damaged. And that requirement really hasn't been much of a problem, apparently, until now. Because insurance companies that have always offered homeowners insurance policies are refusing to offer it now in ever-increasing large swaths of the country because, quite simply, the weather has gotten too damn crazy and the insurance companies are struggling to make money because the insurance companies are having to pay out more money to fix the homes than they are pulling in premiums. And so the Senate Budget Committee had a hearing a few weeks ago about that. And it turned out that Congress is being warned that the repercussions of this situation have the potential to affect far more people than just the Americans with mortgages who like to call themselves homeowners, and the actual homeowners who also have insurance. This has the potential to affect us all. And so today I'm going to save you time so that you don't have to watch the entire hearing and give you the highlights, because there's information that I learned that if I were ever transformed into a different person and wanted a home and needed insurance for it, this information would certainly help me, and hopefully you, to avoid some garbage companies and pick safer options, especially in the state of Florida. And, of course, you're also going to learn about the more systemic risk that I was completely unaware of, that this homeowner insurance situation poses to, well, perhaps the entire world economy. And if information like that sounds valuable to you, please support this show. I know that being pitched for donations all the time is annoying, but this business model, where you support the show directly with cash, is the only way I can do this show and keep total editorial freedom. You can pay per episode via Patreon or whenever you like via PayPal or Venmo or Zelle, or you can send paper checks. Whatever works for you also works for us, and all the options are listed on the Support This Show page on congressionaldish.com. Because we are determined to keep this show free to listen to, we're not putting up a paywall, and free of corporate influence, so that I can continue to tell you things that powerful companies and politicians don't want you to know. And so, yeah, please show us the money, and we'll keep producing episodes like these. But to get started, let's make sure we have the background information that we need to really understand what the witnesses you'll be hearing from today are talking about. And so here's a little bit on the basics of insurance. So banks that issue mortgage loans, which are the loans that people use to buy houses, well, the banks require that the people borrowing the money have homeowners insurance for as long as they owe the bank money. The banks require this because if the person can't pay the money back, the bank will take the home, and the banks don't want to take possession of a home that they can't sell because it's a broken piece of shit. As a result of this standard bank requirement, and the fact that most so-called homeowners are in fact indebted to the banks and don't have a choice but to buy homeowners insurance, 85% of all U.S. homeowners do have homeowners insurance. It's a huge market, with insurance companies selling over $15 trillion worth of insurance policies every single year. The insurance companies make money by pricing their insurance in a way that ensures that on average, they bring in more money in premiums paid by the homeowners than they pay out to the homeowners to fix damages. And in general, most homeowners insurance contracts require them to fix most weather-related disaster damages, except for flooding. And one day we'll probably have to do a deep dive on it, but that day is not today. But the problem is that lately, our climate is less predictable than it used to be, and insurance companies are having to pay more damages than they used to. And so to get us started with highlights from the hearing, here's Senator Chuck Grassley of Iowa introducing our first witness.
Commissioner Glenn Mulready has served as Oklahoma's 13th insurance commissioner and was first elected to this position in 2019. Commissioner Mulready started his insurance career as a broker in 1984 and also served in the Oklahoma State House of Representatives.
And here's part of Oklahoma Insurance Commissioner Mulready's opening statement in the June 5th Senate Budget Committee hearing.
As natural disasters continue to rise, understanding the dynamics of insurance pricing is crucial for both homeowners and policymakers. Homeowners insurance is a fundamental safeguard for what is for many Americans their single largest asset. This important coverage protects against financial loss due to damage or destruction of a home and its contents. However, recent years have seen a notable increase in insurance premiums. One significant driver of this rise is convective storms and other severe weather events. Convective storms, which include phenomena like thunderstorms, tornadoes, and hail, have caused substantial damage in various regions. The cost to repair homes and replace belongings after such events has skyrocketed, leading insurance companies to adjust their premiums to cover that increased risk. Beyond convective storms, we've witnessed hurricanes, wildfires, and flooding. These events have not only caused damage, but have also increased the long-term risk profile of many areas. Insurance companies are tasked with managing that risk and have responded by raising premiums to ensure they can cover those potential claims.
Glenn Mulready is an Oklahoma Republican confirming that in his position as a regulator of insurance markets, he has witnessed an increase in severe weather events that are causing problems in the insurance market. And an increase in storms is a change, and storms are part of the climate, which means, put in other words, the climate is changing, which in my experience is just obvious. And 2 hurricanes in particular made that crystal clear to me recently. Because on October 7, 2018, I was watching the Weather Channel, which I do far more often than is normal, and I saw that a cluster of thunderstorms near Cancun was expected to move towards the United States over the next couple of days. Now, at the time, the weather models, which use historical data to try to predict what a storm will do, were saying that the storm could become, at most, a Category 1 hurricane, which is nothing that the Gulf Coast can't handle. But at that same time, we also knew that the water temperature in the Gulf of Mexico was at a record high, which is a situation we are in again right now in 2024, by the way. But what that means is that it's tough for weather models to accurately predict hurricane behavior when the conditions were never like that before. I remember saying to my husband that I thought that hurricane was going to beat the projections and hit the United States at stronger than a Category 1. And I watched the development of the storm closely to test my theory. A theory that I had because climate scientists had been warning us for decades that warmer ocean temperatures would lead to stronger hurricanes. And I hate how right I was. Because 4 days later, on October 11th, 2018, Hurricane Michael, a small Category 5 buzzsaw of a hurricane, absolutely destroyed Mexico Beach, Florida. The 14-foot storm surge wiped entire neighborhoods off of their foundations, with entire homes being relocated blocks away from where they once stood. But those were the lucky ones, because most homes, when it was all over, simply ceased to exist. And while the forecasters were able to give days of warning that a storm, while they didn't know how strong it would be, but a storm would be hitting the Florida coast, they were way off on the intensity, which isn't surprising, because there was no historical data to be used with water temperatures that were so warm, and unprecedented conditions create unprecedented events. It was a terrifying thing to watch, as I had never seen a hurricane go from a cluster of thunderstorms to a Category 5, the highest level on the scale, in just 3 days. But almost exactly 5 years later, I saw something worse. When on October 21st, 2023, a cluster of showers and thunderstorms in the Pacific Ocean became a low-pressure system. The next day, on October 22nd, it had become a tropical depression. And 6 hours later, it became Tropical Storm Otis. Now, at this point, I remember that Otis was projected, a lot like Michael, to make landfall as a tropical storm or maybe a Category 1 hurricane. And on October 23rd, to match this forecast, a tropical storm warning and hurricane watch were simultaneously issued for Acapulco, Mexico. But the very next day, on October 24th, Otis slammed into and destroyed Acapulco, Mexico as a Category 5 hurricane. And again, while the models got the track of the storm right, no one predicted that level of rapid intensification. It took only 9 hours for Otis to go from a predicted tropical storm to a reality hurricane Category 5, which meant that that Category 5 hurricane hit Acapulco with essentially no warning. It's one of the scariest things I've ever seen. And no one who doesn't have a financial incentive to deny that our global climate is changing seems to be doing it anymore. From the wildfires that have turned entire cities to dust, to the softball-sized hailstones shattering every window in their wake, to the ferocious hurricanes intensifying at rates never seen before. It's simply undeniable, and on this podcast, a changing climate is considered an established fact. Which brings us to our next witness. Here's Senator Sheldon Whitehouse of Rhode Island with an introduction.
The first witness is Raid Masullin. Raid is an actuary with 45 years of experience in insurance, specializing in property, pricing, natural perils, reinsurance, agriculture, catastrophe risk modeling, public policy development, and climate risk.
And here's the essence of what Wade Masullin's opening statement contained.
Evidence of increasing risk abounds, including Hurricane Otis in 2023, which rapidly intensified from a tropical storm to a Cat 5 hurricane and devastated Acapulco in Mexico. Last summer, water temperatures off Florida exceeded 100 degrees Fahrenheit. Last week, as was alluded to earlier, NOAA forecast an extremely active hurricane season for 24. We've seen losses in the mid-Atlantic from Sandy, record flooding from Harvey, and extreme devastation from Maria, among others. In coming decades, we must prepare for the possibility of more extreme hurricanes and coastal flooding from Texas to New England.
The experts in the insurance industry directly connected the troubles in the homeowners insurance industry with our rapidly changing climate. But climate change wasn't the only factor discussed. Here's Glenn Mulready again, the insurance commissioner from Oklahoma.
Another major factor influencing homeowners insurance premiums is inflation. Inflation affects the cost of building materials, labor, and other expenses related to home repair and reconstruction. As the cost of living increases, so does the cost of claims for insurers. When the price of lumber, steel, and other essential materials goes up, the expense of repairing or rebuilding homes also rises. Insurance companies must reflect these higher costs in their premiums to maintain financial stability and ensure they can meet those contractual obligations to policyholders.
And for some additional information about how inflation is affecting homeowners insurance, we're going to turn to another witness. Here's Senator Chuck Grassley of Iowa again with an introduction.
Dr. E.J. Antoni is a research fellow at the Heritage Foundation Grover M. Herman Center for Federal Budget. His research focuses on fiscal and monetary policy, and he previously was an economist at the Texas Public Policy Foundation. Antoni earned his master's degree and doctor's degree in economics from Northern Illinois University.
And here's that budget dude's information about why inflation is hitting the homeowners insurance market particularly hard.
Since January 2021, prices have risen a cumulative 19.3% on average in the American economy. Construction prices for single-family homes have risen much faster, up 30.5% during the same time.
And Wade Muselin, the guy who's been in the insurance industry longer than I've been alive, added this to the inflation conversation.
I will just note that sometimes climate change itself can contribute to the inflation we've been talking about. For example, there were beetle infestations and droughts and fires in Canada, which decimated some of the lumber crop and led to a forest and led to a five-fold increase in the cost of lumber a few years ago. So some of this, claims inflation is actually related to climate change, and I think we need to address that.
And so the overall effect of increasing weather disasters plus inflation, which is especially high in construction products, is having this overall effect on the industry. Here's Senator Sheldon Whitehouse of Rhode Island.
A New York Times investigation found that the insurance industry lost money on homeowners coverage in 18 states last year. And the states may surprise you. The list includes Illinois, Michigan, Utah, Washington, and Iowa. Insurers in Iowa lost money each of the last 4 years. This is a signal that hurricanes and earthquakes, once the most prevalent perils, are being rivaled by hail, windstorms, and wildfires.
And so, with the insurance industry losing money on homeowners insurance in 18 states, some insurance companies are choosing to say this, and in some of those states are refusing to offer insurance there anymore to anyone. Now, insurance companies not wanting to insure homes has long been a problem in Florida. But what we're seeing now is that problem spreading to other states. And because Florida has been dealing with insurance companies not wanting to do business there for a long time, Florida had to come up with a government solution to a problem that the market straight up refused to solve. And so starting after Hurricane Andrew in 1992, when extensive damage bankrupted many insurance companies in Florida and caused other insurance companies to say this and exit the state, well, the government of Florida created the Citizens Property Insurance Corporation, which you will hear referred to as Citizens in this hearing, which is a Florida government-run insurance company. Citizens was created to provide insurance to people who couldn't get it from the private companies. And over the following years, Citizens repeatedly expanded as Florida continued to get hit with weather disaster after weather disaster. Now, several features of Citizens can make it a good option if you can get it. Citizens has a price growth cap, meaning that there's a limit to how much Citizens can jack up its rates on you every year. And it's not allowed to just cancel policies following a disaster. And so it's often more reliable than the insurance offered by private companies. However, the disadvantage of Citizens is that its policies more often than not provide less coverage than private insurers. They pay out for fewer kinds of disasters and damage, and they do have coverage limits. But now, for more on Citizens Insurance in Florida, let's go back to Reid Muselin. And in his testimony, he's going to mention the NFIP, which is the National Flood Insurance Program. Like I said before, most homeowners insurance doesn't cover flooding. And so the federal government created a program to fill that insurance hole. And that's a whole thing that has to be a topic for another day. But when he says NFIP, that's the National Flood Insurance Program. Okay, here's his testimony.
Hey, my name is Reid Muselin. I'm an actuary who has extensive experience in natural hazard risks and funding arrangements for the damage and loss they cause. I've worked with many public sector entities on policy responses to the challenges of affordability, availability of insurance, and community resilience. This work included participating in Florida's response to Hurricane Andrew, which included the creation of the Florida Hurricane Catastrophe Fund and Citizens Property Insurance Corporation. The CAT Fund and Citizens can access different forms of funding than traditional insurance companies. Instead of holding sufficient capital or reinsurance before an event to cover the cost of potential losses, both entities use public sources of capital to reduce upfront costs by partially funding losses post-event through bonding and assessments. All property casualty insurance policyholders, whether in Citizens or not, are subject to its assessments, while the CAT Fund can also assess almost all policies, including automobile. This approach exposes Floridians to debt and repayment if large losses occur, and it subsidizes high-risk policies from the entire population. These pools, others like them in other states, and the NFIP have contributed to rapid development in high-risk areas, driving higher costs in the long run. In Florida, national insurers have reduced their exposure, as a significant proportion of the insurance market has moved to Citizens or smaller insurers with limited capital that are heavily dependent on external reinsurance. Now, to date, Florida's system has been successful in meeting its claims obligations, while improvements in building codes have reduced loss exposure. However, for a variety of reasons, including exposure to hurricanes, claims cost inflation, and litigation, Florida's insurance premiums are the highest in the nation, causing significant affordability stress for consumers. According to market research from Bankrate, the average premium for a $300,000 home in Florida is 3 times the national average, with some areas 5 times the national average. A major hurricane hitting a densely populated area like Miami could trigger large and long-lasting post-event assessments, or even exceed the system's funding capacity. Continued rapid exposure growth and more extreme hurricane losses amplified by climate change will cause increasing stress on the nation's insurance system, which may be felt through solvency issues, non-renewals, growth of government pools, and affordability pressure.
And continuing this examination of Citizens Insurance in Florida and other state government insurance programs like it is Senator Jeff Merkley of Oregon and Dr. Ishita Sen. But first, here's Senator Sheldon Whitehouse with an introduction to our final witness.
Our second witness is Dr. Ishita Sen. Dr. Sen is an assistant professor at Harvard Business School. Her recent research examines the pricing of property insurance and the interactions between insurance and mortgage markets. This includes the role that institutions and the regulatory landscape play and the broader consequences for real estate markets, climate adaptation, and our overall financial stability.
And here's her exchange with Senator Jeff Merkley of Oregon.
So in looking at the materials, I saw that Citizens Property Insurance Company, I gather that's Louisiana and Florida, that have a completely state-backed program. Well, all right, so if the state becomes the insurer of last resort and they now suffer the same losses that a regular private insurance company is suffering, now the folks in the state are carrying massive debt. So that doesn't seem like a great solution.
That's definitely a problem, right? I mean, the problem is, of course, that whether the state then has the fiscal capacity to actually withstand a big loss, like a big hurricane season, which is a concern that was raised about citizens. And in such a scenario, then in a world where they do not have enough tax revenue, then they would have to sort of go into financial markets, try to borrow money, which could be very costly and so on. So fiscally, it's going to be very challenging for many cities and many municipalities and counties and so on.
But despite these obvious problems with a taxpayer-backed insurance system like they have in Florida and Louisiana, well, here's Senator Sheldon Whitehouse of Rhode Island.
In 2022 and 2023, more than a dozen insurance companies left the Florida residential market, including national insurers like Farmers. Residents fled to Citizens Property Insurance, the state-backed insurer of last resort, which ballooned from a 4% market share in 2019 to as much as 17% last year. If it has to pay out claims that exceed its reserves, Citizens can levy a surcharge on Florida insurance policy holders across the state. Good luck with that, particularly if the surcharge grows to hundreds or even thousands of dollars. To depopulate its books, Citizens has let private insurers cherry pick out its least risk policies. Those private insurers may have problems of their own, as we will hear today.
So, let's just do an overview here. Private insurance companies refused to provide insurance, so the government stepped in. But the government program relies on taxpayer money and might not be sustainable, so they bring the private sector back in. What could go wrong? Well, apparently, a lot. Because it's a different kind of private insurance company that is apparently filling the void right now in Florida. So, there's really three kinds of insurance broadly. So there's the insurance provided by huge companies like State Farm, which offer insurance all over the country. Those are the companies that are pulling out of states that they're struggling to collect profits in. We've already discussed the second kind of insurance, which is the government-run insurer, such as Citizens Property Insurance Corporation. But after creating Citizens in the 1990s, in the early 2000s, Florida adopted a policy where the state of Florida incentivized, as in paid, private insurers to transfer Citizens policies into their companies, which led to a third kind of insurance, which are new, smaller private insurance companies entering Florida, which would get paid to take over the policies from Citizens. Now, initially, homeowners like you were allowed to refuse to switch to the private insurance company if you didn't want to. However, since 2022, Florida has forced its homeowners to accept the transfer if certain conditions were met. Now, to protect people like you from taking out insurance policies with a company, just like in other financial industries, there are ratings agencies that are responsible for determining the solvency of insurance companies. And a lot of us, myself included, first learned about these ratings agencies in the aftermath of the 2008 financial crash, because the ratings agencies weren't doing their jobs. In the run-up to the 2008 financial crash, ratings agencies, which are responsible for labeling junk loans as junk, didn't do that. Instead, the ratings agencies turned a blind eye to bankers who were creating packages of loans. In these packages, they were taking junk mortgage loans that were likely to never be paid back and mixed those with excellent loans made to people who were very likely to pay their loans back. But they allowed those packages, which were mixed with the two, to be given the top rating, labeled as safe as can be, despite the packages being poisoned with some junk. And when, as should have been predicted by the ratings agencies, the junk in the packages, the junk in these so-called securities, when that junk started to stink, when the loans were not paid back, there was a domino effect. The banks didn't get their money. And so the Wall Street firms that bought the packages, those securities, they didn't get their money. And then the insurance companies that insured the securities, those packages full of junk, those insurance companies went broke trying to pay the banks and the Wall Street firms. And because these packages of junk had been sold all over the world in a massive game of financial hot potato, when the music stopped, the entire world's economy almost came crashing down. The only reason it didn't is because our tax money filled the hole created by the reckless Wall Street bankers, a hole that couldn't have been created in the first place had the ratings agencies done their jobs and identified the junk in those packages as junk. And so ratings agencies matter. And the smaller private insurance companies that have flooded the Florida market have been primarily rated by a ratings agency named Demotech. And so here's Dr. Ishita Sen of Harvard, who just completed a study on this issue. And just so you know, in this testimony, you're going to hear her refer to GSEs, which stands for Government-Sponsored Enterprises, which are the companies otherwise known as Fannie Mae and Freddie Mac. The government-sponsored enterprises, Fannie Mae and Freddie Mac, what they do is they purchase and guarantee the mortgage loans that we take out from our private banks so that the banks can have more cash to lend out to more hopeful homeowners. Basically, GSEs, Fannie Mae and Freddie Mac, buy mortgages and create packages to sell to Wall Street. And the GSEs, Fannie Mae and Freddie Mac, only purchase loans and put into their package loans that are backed by good quality homeowners insurance, which means they need to know the difference between a good insurance company and a junk insurance company, so as to prevent the domino effect that tanked the world's economy when mortgage packages were filled with junk in the years before 2008. And so, now that you know that, here's Dr. Ishita Sen.
Insurance is critical to the housing market. Property insurers help households rebuild after disasters by preserving collateral values and reducing the likelihood that a borrower defaults. Insurance directly reduces the risks for mortgage lenders and the government-sponsored enterprises such as Fannie Mae and Freddie Mac. Mortgage lenders, therefore, require property insurance, and the GSEs only purchase mortgages backed by insurers who meet minimum financial strength ratings, which measure insurers' solvency and ability to pay claims. The GSEs accept three main rating agencies: AM Best, S&P, and more recently, Demotech. And to provide an example, Fannie Mae requires insurers to have at least a B rating from AM Best or at least an A rating from Demotech to accept a mortgage. Now, despite having this policy in place, we find a dramatic rise in mortgages backed by fragile insurers and show that the GSEs, and therefore the taxpayers, ultimately shoulder a large part of the financial burden. Our research focuses on Florida because of availability of granular insurance market data, and we show that traditional insurers are exiting, and the gap is rapidly being filled by insurers rated by Demotech, which has about 60% market share in Florida today. These insurers are low quality across a range of different financial and operational metrics and are at a very high risk of becoming insolvent. But despite their risk, these insurers secure high enough ratings to meet the minimum rating requirements set by the GSEs. Our analysis shows that many actually would not be eligible under the methodologies of other rating agencies, implying that in many cases these ratings are inflated and that the GSE's insurer requirements are miscalibrated.
Uh-oh. And there's more.
Before I end, I want to leave you with two numbers. Over 90%, that's our estimate of Demotech's market share among loans that are sold to the GSEs. And 25 times more, that's Demotech's insolvency rate relative to AM Best among the GSE-eligible insurers.
So Congress is being told that a ratings agency, Demotech, that is rating a huge percentage of the small private homeowners insurance companies is doing a bad job and allowing junk companies to insure a huge number of homes. And there was a debate in the hearing about how big of a deal this is. So here's Oklahoma's Insurance Commissioner Glenn Mulready.
Mr. Ranking Member, if I can, I'd like to address something before that, just quickly. This focus on the rating agencies. I would agree with that if that were sort of the be-all, end-all, but the state insurance commissioners in each 50 states is tasked with the financial solvency of the insurance companies. We do not depend on rating agencies for that. We are doing financial exams on them. We are doing financial analysis every quarter on each one of them. So I would agree if that was the sort of be-all, end-all, forgive that phrase, but it's not at all. And we don't depend very much at all on those rating agencies from our standpoint.
And here's Dr. Ishita Sen's response.
On the point about regulators sort of looking at, and we shouldn't pay, rating agencies is not something that we need to look at. I would just point out that in Florida, if you look at the number of exams that the Demotech rated insurers, that, by the way, have a 20% insolvency rate relative to 0% for traditional insurers, they get examined at the same rate as the traditional insurers like Farmers and Allstates get examined, which is not something that you would expect. If you're more risky, you would expect regulators to come look at them much, much more frequently. And the risk-based capital requirements that we have currently, which were designed in 1980s, they are just not sensitive enough to new risks like wildfire and hurricanes and so on, and also not as well designed for under-diversified insurance companies, because if so, all of these insurers were meeting the risk-based capital requirements. However, at the same time going insolvent at the rate of 20%. So those two things sort of don't really go hand in hand.
And so here's her bigger picture concern.
We next look at how fragile insurers create mortgage market risks. So in the aftermath of Hurricane Irma, homeowners with a policy from one of the insolvent Demotech insurers were significantly more likely to default on their mortgage relative to similar borrowers with policies from stable insurers. This is because insurers that are in financial trouble typically are slower to pay claims or may not pay the full amounts. But this implies severe economic hardships for many, many Floridians, despite having expensive insurance coverage in place. However, the pain doesn't just stop there. The financial costs of fragile insurers go well beyond the borders of Florida, because lenders often sell mortgages, for example, to the GSEs, and therefore the risks created by fragile insurers spread from one state to the rest of the financial system through the actions of lenders and rating agencies. In fact, we showed two reasons why the GSEs bear a large share of insurance fragility risk. First is that lenders strategically securitize mortgages, offloading loans backed by Demotech insurers to the GSEs in order to limit their counterparty risk exposures. And second, that lenders do not consider insurer risk during mortgage origination for loans that they can sell to the GSEs, even though they do so for loans that they end up retaining, indicating lax insurer screening standards for loans that can be offloaded to the GSEs.
I smell a new round of hot potato. It sure sounds to me like Fannie and Freddie are packaging loans insured by garbage companies, which is probably fine until disaster hits and those companies fail to pay for the damage. That's when the music stops. The music stops when disaster hits. And so here's Raid Mucilin, the guy who's been in the insurance industry for forever and a day.
It's sort of a set of dominoes. You start with potentially claims issues with the insurers, being stressed and not ability to pay claims. You have post-event rate increases, as we've seen in Florida. You could have situations where people cannot secure insurance because they can't afford it. Then that affects their mortgage security and so on and so forth. So there are a number of ways that this could affect the financial system, sir.
They say history doesn't repeat itself, but it rhymes. Is anyone else hearing some beats resembling 2008? Because Senator Sheldon Whitehouse and Dr. Ishita Sen sure are.
And you see in this, and I'm quoting you here, parallels in the 2008 financial crisis. What parallels do you see?
So just like what happened during the financial crisis, there were rating agencies that gave out high ratings to pools of mortgages backed by subprime loans. Here we have a situation where rating agencies like Demotech are giving out inflated ratings to insurance companies. The end result is sort of same. There is just too much risk and too many risky mortgages being originated, in this case, backed by really low quality insurers that are then entering the financial system. And the consequences of that has to be borne by, of course, the homeowners, but also the mortgage owners, GSEs, the lenders, and ultimately the federal and state governments.
You say, this will be my last question, the fragility of property insurers is an important channel through which climate risk might threaten the stability of mortgage markets and possibly the financial system. What do you mean when you refer to a risk to the financial system?
Well, as I was explaining, the GSEs, if there are large losses that the GSEs face, then those losses have to be plugged by somebody, so the taxpayers. That's one channel through which you've got risk to the financial system. And the GSEs serve as a backstop in the mortgage market. They may not have the ability or capacity to do so in such a scenario, which affects mortgage-backed security prices, which are held by all sorts of financial institutions. So that starts affecting all of these institutions. On the other hand, if you've got a bunch of insurers failing, another channel is these insurers are one of the largest investors in many asset classes like corporate bonds, equities, and so on. And they may have to dump these securities at inopportune times, and that affects the prices of these securities as well.
Hot potato. And Senator Sheldon Whitehouse summarized the game really well.
The federal budget takes a hit because these insurers and their policies are accepted by Freddie Mac and Fannie Mae, who either own or guarantee a large part of our $12 trillion mortgage market. This all sounds eerily reminiscent of the run-up to the mortgage meltdown of 2008, including a role of potentially captive or not fully responsible rating agencies.
Yep. And the music stops when weather disaster strikes.
This isn't all that complicated. Climate risk makes things uninsurable. No insurance makes things unmortgageable. No mortgages crashes the property markets. Crashed property markets trash the economy. It all begins with climate risk, and a major party pretending that climate risk isn't real imperils our federal budget and millions of Americans all across the country.
For most of this episode, outside of the introductions, you've been hearing the voices of senators in the Democratic Party because they were fully engaged in the conversations with the insurance industry experts that they invited to testify. But you should know what the Republicans were up to in this hearing, because it's an election year after all. And so first up, here's an example from Senator Chuck Grassley, who has been the senator representing Iowa for the last 43 years, which is longer than I've been alive. Iowa was the subject of the New York Times article discussed earlier in this episode, which we put in this episode's show notes for you along with all of the sources we used to give you information today. But that article was detailing how an increase in severe weather has prompted insurers to pull out of the state of Iowa in the wake of some severe storms, including a derecho, which is a line of storms that have winds that are as strong as hurricane winds. But instead of swirling in a circle, they blow in a straight line, causing widespread damage as a cold front marches across the land, just as it did in Iowa. And Iowa experienced massive hailstorms that fucked up roofs and shattered home and car windows all over the state, leaving Chuck Grassley's constituents without any affordable home insurance options when the big companies abruptly pulled out of Iowa over the last year, just like they did in Florida 30 years ago. And you can decide for yourself if this attitude towards the increasingly dangerous weather events like the ones his state has experienced lately is serving his constituency well.
Insurance premiums are far too high across the board and may increase after the recent storms, including those very storms in my state of Iowa. Climate change isn't the primary driver of insurance rates hikes, and collapse of the insurance industry isn't imminent, although I'll have to say Iowa had 6 property and casualty companies pull out of insuring Iowans. Climate change doesn't explain why auto insurance premiums in 2024 have increased by a whopping 20% year over year. It also doesn't account for the consistent failure of liberal cities to fight crime, which has raised insurance risk and even caused insurers to deny coverage. Expensive liberal policies, not climate change, are much to blame for these market dynamics.
So that was one line of the Republicans in Congress, that climate change isn't the problem. But then there was Senator Ron Johnson of Wisconsin, which is another state whose weather disasters cost insurance companies more money than premiums could cover last year. Well, here's Wisconsin's Republican senator with his view on the situation.
Okay.
Yes, sir.
So we've had testimony before this committee that we've already spent $5 to $6 trillion. That's 5,000 to 6,000 billion dollars trying to mitigate climate change. We haven't made a dent in it. Their estimates it's going to cost tens of trillions of dollars every year to reach net zero. So again, this is not the solution for a real problem, which is the broken insurance market. I have enough Wisconsin residents live on the Gulf Coast in Florida to know after Hurricane Ian, we've got some real problems in Florida. But fixing climate change isn't the solution.
And in case you're wondering, Senator Chuck Grassley has taken over $1.8 million from people in the energy industry since 1989, as the records don't go back far enough to show his entire obscenely long Senate career. And Senator Ron Johnson has taken over $1.4 million from those profiting from the pollution that is responsible for the climate changing as rapidly as it is, almost matching Senator Grassley despite Senator Johnson's records accounting for 20 fewer years. In general, since the Center for Responsive Politics started keeping track in 1989, people in the oil and gas industry have showered Republican members of Congress with more than $327 million, which is almost 80% of the money that the oil and gas people have legally bribed our members of Congress with over the last 34 years, which I'm suspecting helps explain why Republicans remain so proudly the party of pollution and fossil fuels. And one of the things that dirty money buys is Republican invitations to hearings to witnesses who will taint our hearings with nonsense which serves the interests of the polluters they serve. Witnesses like the one they invited to this Senate hearing, in this case, E.J. Antoni, a federal budget researcher with no climate science background whatsoever, who works at the Heritage Foundation, a big business promoting think tank that is currently in the process of trying to staff and create policy for the second nightmare Trump administration with its Project 2025. Basically, when it comes to anything related to climate change, I've come to count on members of the Heritage Foundation being dishonest, disingenuous pricks, and E.J. Antoni proved himself to be no exception.
The increase in claims related to weather events has undoubtedly increased, but it is not due to the climate changing. This is why the insurance and reinsurance markets do not rely heavily on climate modeling when pricing premiums. Furthermore, climate models are inherently subjective, not merely in how the models are constructed, but also by way of the inputs that the modeler uses. In other words, because insufficient data exists to create a predictive model, a human being must make wide-ranging assumptions and add those to the model in place of real-world data. Thus, those models have no predictive value for insurers.
Again, this guy has no science background, and what he just said is pure horseshit. Insurance companies simply do use climate models. They use historical data to try to predict the likelihood of severe weather events when determining their pricing. And reinsurance companies, companies who provide insurance to the insurance companies like Munich Re and Swiss Re, have entire divisions dedicated to using climate models for natural hazard research to help them determine their pricing. E.J. Antoni, as the Republican witness in this hearing, just straight up bullshitted Congress, which is precisely what he was invited by the party of pollution to do. The only Republican senator who came close to acknowledging reality was Senator Mitt Romney of Utah.
Senator Romney.
My colleague, Mr. Merkley, I wish there was something we could do that would reduce the climate change we're seeing and the warming of the planet. But I've seen absolutely nothing proposed by anyone that reduces CO2 emissions, methane gases, and the heating of the planet. Climate change is going to happen because of the development in China and Indonesia and Brazil. And the only thing that actually makes any measurable impact at all is putting a price on carbon. And no one seems to be willing to consider doing that. Everything else that's being talked about in the climate
two
front,
bills.
I know you and I are, but you guys had reconciliation. You could have done it all by yourselves, and you didn't. So the idea that somehow we're going to fix climate and solve the insurance problem is pie in the sky. That's avoiding the reality that we can't fix climate because it's a global issue, not an American issue. Anyway, let me turn back to insurance.
At least he wasn't pretending that there's nothing at all that can be done. As someone in the market solutions to all problems camp, he at least acknowledges that putting a financial cost on fossil fuel burning would help. There are plenty of solutions, most notably keeping the fucking fossil fuels in the ground, that have been repeatedly confirmed by actual scientists for decades as solutions that would minimize the effects of a rapidly changing climate and our ability to adapt. A tax on carbon pollution is just one piece of that, but at least he's offering that much. The rest of his party, though, Senator Whitehouse is right. The Republican Party is a major obstacle to tackling anything related to this problem. In this regard, in the pollution and fossil fuel burning regard, this is where there is a major difference between our two corporate parties. The Democrats seem to give a real shit about minimizing fossil fuel burning and slowing the rate that our climate is changing. The Republicans, though, with the half-assed exception of Mitt Romney, well, the Republicans don't. And despite Genocide Joe and all the things there are to hate about his administration, the Democrats are infinitely better when it comes to taking real action to reduce fossil fuel pollution and the risks that it poses to our health and property. The Republicans will not fix any problems that they falsely continue to claim can't be fixed, and we should take them at their word and vote accordingly. But back to the homeowners insurance problem specifically. The witnesses did have some suggestions for Congress, or at least for those willing to listen, as to how we can help start to fix the issues that were identified. So first up, here's Dr. Rashida Sen.
Ultimately, what the solution is something that is obviously the main question that we are here to answer. But I would say that it is extremely hard to really figure out what the solution is, in part because we are not in a position right now to even answer some basic facts about how big the problem is, what exactly the numbers look like. For instance, we do not know basic facts about how much coverage people have in different places, how much they're paying. And when I say we don't know this at a granular enough level because the data does not exist. And the first step towards sort of designing any policy would for us to know exactly how bad the problem is, and then we sort of come up with a solution for that and start to evaluate these different policy responses. Right now, we're sort of trying to make policy blindfolded.
And the somewhat good news is that some in Congress are aware of this problem and have already started trying to do something about it. Here's Senator Chris Van Hollen of Maryland speaking to Dr. Rashida Sen.
One way to address this, and I think it was discussed in a different matter, is the need to get the data and to get consensus on where the risks lie, which is why last year, Senator Whitehouse, Senator Warren, and I sent a letter to the Treasury Department, to the Federal Insurance Office, urging them to collect information from different states. I'm a supporter of a state-based insurance system for property and casualty insurance, but I do think it would benefit all of us to have a sort of national yardstick against which we can measure what's happening. So, Dr. Sen, could you talk a little bit about the benefit of having a common source of insurance data through the FIO and how that could benefit state regulators and benefit all of us?
Yeah, absolutely. Thanks for bringing that up. That's just the first order importance, I think, because we don't even know the basic facts about this problem at a granular enough level. The risks here are local, and so we need to know what's going on zip code by zip code, census tract by census tract. And for regulators to be able to figure out exactly how much risk is sitting with each of these insurance companies, they need to know how much policies they're writing, what's the type of coverage they're selling, in what are the cancellations looking like in different zip codes. Only then can they figure out exactly how exposed these different insurers are, and then they can start designing policy about whether the risk-based capital ratios look all right or not, or should we put a surcharge on wildfires or hurricanes and so on. And we do need a comprehensive picture. We just can't have a particular state regulator look at the risks in that state because, of course, the insurer is selling insurance all over the country, and we need to get a comprehensive picture of all of that.
To which Senator Van Hollen responded,
No, I appreciate that. I gather that the Treasury Department's getting some resistance from some state insurance regulators. I hope we can overcome that, because I'm not sure why anyone would want to deny, the American people the benefit of the facts here.
which isn't great that some states are not participating willingly, but at the very least, there appears to be some movement in the right direction. And sticking to the topic of data collection, in this upcoming exchange between Glenn Mulready, who is the insurance commissioner for the state of Oklahoma, and Senator Van Hollen, Glenn Mulready will mention the FIO, which is the Federal Insurance Office at the Treasury Department, the part of the Treasury Department that the 3 Democratic senators sent their letter to in September of 2023.
If you didn't know, the NEIC, National Association of Insurance Commissioners, is in the midst of a data collection right now that will collect that data for at least 80% of the homeowners market. And we have an agreement with FIO to be sharing that data with them. They originally came to us. I got a letter from FIO, and they were requesting data that we did not actually collect at the zip code level. And they had a very stringent timeline for that. So on my response, well, it wasn't no, it was just, look, we can't meet that timeline. We don't collect that today. We can in the future. But from that is where this has grown, the data called by the NEIC.
So I saw that there had been now this effort on behalf of the state. So is this now been worked out? Are there any states that are objecting to your knowledge at this point in time in terms of sharing data?
I don't know about specific states.
Okay.
We will be collecting data that will represent at least 80% of the market share.
So I guess it's a little bit comforting to know that there is an effort to get a clearer picture of the extent of the problem, which is an essential first step. In bigger picture, here's Insurance Commissioner Glenn Mulready with his suggestion for what to aim for to make the private homeowners insurance market function properly.
I believe the most essential aspect of managing insurance premiums is fostering a robust, competitive free market. Competition among insurance companies encourages innovation and efficiency, leading to better pricing and services for consumers. When insurers can properly underwrite and price for risk, they create a more balanced and fair market. This involves using advanced data analytics and modeling techniques to accurately assess the risk levels of different properties. By doing so, insurance companies can offer premiums that reflect the true risk, avoiding excessive charges for low-risk homeowners and ensuring high-risk properties are adequately covered. Regulation also plays a crucial role in maintaining a healthy insurance market. Policyholders must strike a balance between consumer protection and allowing insurers the freedom and flexibility to adjust their pricing based on the risk. Overly stringent regulations can stifle competition and lead to market exits, reducing choices for consumers. We've seen this play out most recently in another state where there were artificial caps put in place on premium increases. That worked well for consumers in the short term, but then one by one, all of the major insurers began announcing they would cease to write any new homeowners insurance in that state. These are all private companies, and if there's not the freedom and flexibility to price their products properly, they may have to take drastic steps, as we've seen. Conversely, a well-regulated market encourages transparency and fairness, ensuring that homeowners have access to the most affordable and adequate coverage options.
And Senator Mitt Romney, the only reasonable Republican in this hearing, presented some ideas that seem reasonable and workable to me. So here's his thoughts along with his exchanges with all of the insurance industry experts.
So the question is, what actions can we take? Fiscal reform, yes, to try and deal with inflation, except I want to note something, for Mr. Antoni, because you're esteemed at the Heritage Foundation. 72% of federal spending is not part of the budget we vote on. So we talk about Biden wants to spend all this, 72% we don't vote on. We only vote on 28%. Half of that is the military. We Republicans want more military spending, not less. So that means the other 14%, which is the Democrats want to expand, there's no way we can reduce the 14% enough to have any impact on the massive deficits we're seeing. So there's going to have to be a broader analysis of what we have to do to rein in our fiscal challenges. I want to underscore that. I would say a second thing we can do besides fiscal reform and dealing with inflation is stopping subsidizing high-risk areas, basically subsidizing people to build expensive places along the coast and in places that are at risk of wildfire. And we subsidize that, and that creates huge financial risk to the system. And finally, mitigation of one kind or another. That's the other thing we can do is all sorts of mitigation, forestry management, having people move in places that are not high risk. But if you want to live in a big house on the coast, you're going to have to spend a lot of money to insure it or take huge risk. That's just the reality. So those are the three I come up with: stop the subsidy, mitigation, and fiscal reform. What else am I missing? Mr. Muslin, and I'm just going to go down the line for those that are sort of in this area to give me your perspectives.
Well, thank you, Senator, and I'd agree with all those things, and I'd also add that we need to start thinking about future-proofing our building codes and land use policies. The sea levels are rising. There's, if you're going to build a house that's supposed to last 75 years, you ought to be thinking about the climate in 75 years when you give somebody a permit to build there. So I'd say that's important. I'd also say that, large disasters also drive inflation because it puts more pressure and demand on labor and materials. More disasters mean supplies that could have been used to build new homes for Americans are diverted to rebuild homes in the past. So certainly doing things to reduce the vulnerability of properties and improve their resilience is important. And I do think, sir, that there are things we can do about climate change with respect over periods of decades that can make a difference in the long run. Thank you.
Thank you. Yes. Sen?
Sure. So before that, one point about inflation that we are missing, which is without doubt, it is a contributing factor. But the US has had inflation in the past without such an acute crisis in insurance markets. So whether that is the biggest cause or not is up for debate. I don't think we have reached a conclusion on inflation being the biggest contributor of rising insurance costs.
It's just the big one. You'd agree it's a big one.
I agree it's a big one, but I wouldn't say it's the biggest one. In terms of policy solutions, I completely agree with you on we need to stop subsidizing building in high-risk areas. That's definitely one of the things that is definitely we need to do that. Mitigation, another point that you bring up. And on that, I would say not only do we need to harden our homes, but we also need to harden our financial institutions, our banks, and our insurance companies in order to make them withstand really large climate shocks that are for sure coming their way.
Thank you. Mr. Mulready?
Thank you, Senator. I would say amen to your comments, but I'll give you three quick things. Number one, FEMA has a survey out that states that every $1 spent in mitigation saves $6 in lost claims. It pays off. Number two, unfortunately, a lot of communities have to have a disaster happen. In Moore, Oklahoma, back a dozen years ago, EF5 hit. It was just totally devastating. After that, the city of Moore changed their zoning. They changed their building zoning codes. And then third, the city of Tulsa, back in the 80s, had horrible flooding happened. And so they invested over decades, infrastructure to prevent flooding. Now we're one of only 2 communities in the country that are Class 1 NFIP rated.
Yeah, thank you.
And so there you go. Now you know there's a hidden risk to our financial system, that there are different kinds of homeowners insurance, some riskier than others. You know our government isn't collecting enough data about any of this. And you know that we should be doing all we can to protect our own homes and local communities from weather threats because, in part, the Republican Party is promising to do jack shit to reduce fossil fuel burning and slow the rate that our climate is changing. The Republicans, except for Mitt Romney, because he actually seemed quite reasonable about all of this. But I consider all of this good to know. I'm glad I know. And I hope you enjoyed learning all of this stuff in this episode, too. Okay, so today I have two individuals, but multiple executive producer credits to announce. If you are new to the Congressional Dish world, executive producer credits are people who support this show at a rate of $535 or more. And every time you hit $535, you get to put an executive producer credit on an episode of your choice. That executive producer credit gives your public vouch to that episode and also moves it up the list of most valuable episodes because for years, people have come to me and said, hey, I'm interested in your podcast. Where should I start? And I don't think I'm the one who should tell you that. I think all the episodes are valuable. And so I leave it to the people who help me produce this, quite literally, with your funds. You're the ones who get to decide what the most valuable episodes are. And for a long time now, the number one most valuable episode is still Contriving January 6th, which is the episode where I listened to all 20 hours of the January 6th committee hearings and narrowed that down to 2 hours to tell you exactly what went on, because what ex-President Donald Trump and his accomplices attempted to do, it was so much bigger than the riot. It was so much bigger than the riot. And I think it's a story that Americans need to know. And so that has the most executive producer credits. But with each of these executive producer credits that I'm going to tell you about right now, it moves all of these episodes up the list. And there's a theme to these executive producer credits. So we're going to start first with Ben Barnett, who is a big-time executive producer because he had 3 executive producer credits, standing by that he has decided to put on Congressional Dish 287 War Money, Congressional Dish 290 Israel War Money, What's Already Law, and Congressional Dish 292 Sabotaging Palestine. And so he sent in a message with these 3 credits, and he said, I'd like to claim 3 executive producer credits on these 3 episodes. I think these are 3 of the most valuable episodes Jen has released and have educated me far more than any of the traditional news media have. It speaks to Jen's integrity in producing such valuable work. Thanks, Ben. Well, thank you for putting your credits on those episodes. I'm happy to see them move up the list because I think they're not only some of the most important work I've ever done, but I think they were definitely 3 of the hardest episodes I've ever done. I may have mentioned this on previous episodes, I don't know, but it remains true that covering the Israel-Palestine situation over these last 8 months, no other topic has affected my personal life in the way that this has. It would have been very, very easy for me had I been able to just say, yep, Israel is the good guy, the end. That would have made my life infinitely easier, but I couldn't do that. So thank you for acknowledging the importance of that work. It's helpful for me to know that it was useful for you based on the fact that I paid some real consequences for it. So along those same lines, I would also like to thank Nick Rabat, who put his executive producer credit on Congressional Dish 292 Sabotaging Palestine. And his message said, I sent over a donation today while listening to your podcast on Palestine. You were telling the truth, the hard truth, the one that is rarely spoken in the USA's media. And I thought I should pitch in and support you with a little bit of money and become an executive producer for the episode, Congressional Dish 292. Also, this work, especially these last few podcasts on the Palestine conflict, must be emotionally draining. And I hope you are taking time to take care of yourself. You more than deserve it. Thank you very much for saying this. I kind of alluded to this already, but it is incredibly emotionally draining. I've really struggled with everything these last 8 months. And honestly, it hasn't stopped because even though I'm focusing on different topics, because there's more than that going on in this Congress, I'm still seeing the pictures of dead babies every single day. Nothing is getting better in Gaza. In fact, things are getting much, much worse in the West Bank. So it's still emotionally draining. This entire job is emotionally draining and has been for 12 years, but this situation has been the absolute worst. So what I did do is I went home and I spent some time with my family, and I brought my sister's kids, who you might remember I lived on the same street as them during COVID. And so I kind of consider them my kids in certain ways. And so I had my kids here for a week. It is one of the reasons that the Boeing episode is delayed. But instead of trying to work while they were here, I spent time with them, and it made me feel better. Although I do see them in all of the pictures of these innocent little Palestinian kids. And that's another reason why it's so emotionally draining. Because if anything like this happened to them, I would lose my fucking mind. So thank you for these executive producer credits. Like I said, it's really helpful to know that those episodes helped you because they've been a sacrifice on my end. So although I shouldn't talk about sacrifice considering what the people in Gaza and the West Bank are going through, it's nothing compared to what they're going through. All right. So I have a few episodes that are in the works right now. And so I don't think there's going to be all that much time between this episode and the next one. I'm going to start banging them out pretty quick. So if you support that work, please support the show. We do need your help. And also, if you haven't done so already, please subscribe to the show. Even if you don't listen to the show on all of the different podcast apps, I know that I have like 10 podcast apps on my phone. I only use Spotify. But if you can go into those other apps and just subscribe to Congressional Dish, it actually really helps the show because podcasting is weird and it's just one of those things that we need to do. So yeah, if you could subscribe to the show, that tells the Apple podcast directory and Spotify and all of these different networks that this is a show that people want to listen to, and it does help its discoverability. Other than that, I hope you're well, and I will talk to you sooner than later. Thanks so much. Talk to you soon. Bye.
We're surrounded now by liars coming at us through our TV screens.
We don't have a domestic spying program.
They're content to fight in black and white despite the many in-betweens. We got a president who plays with the facts. And then he waves a flag to cover his tracks. As if a lie is alright, if the end will justify the means. Now we are so damn tired of
The polar ice caps aren't going away.
We don't think we can deny it anymore. You can stick to your story if you think it flies. But we're not keeping quiet anymore. We are so damn tired of being lied to.
Government jobs consume the profits of the private sector.
We don't think we can deny it anymore. You can stick to your story if you think it flies. But we're not keeping quiet anymore. Now we're not keeping quiet.
These bills represent common sense, bipartisan solutions that actually solve problems.